Welcome to the world of non-current assets disposal. So we're talking about our non-current assets, a resource controlled by the entity as a result of a past transaction that will result in an inflow of future economic benefits for longer than 1 year. Now we're talking about getting rid of it. So our 3 steps include transferring the carrying price of the asset, recording the proceeds from disposal, and then transferring the profit or loss on disposal. So step 1, first of all, is to deal with our historical costs. So you can see the general ledger here, and this is highlighted in yellow. So we've created a new ledger account called disposal of van that we're going to use to total everything up. So this first entry is a credit to van. So we'd have our ledger account for van, it's an asset, so it would be sitting there with a debit balance. Here, we put a credit to it. So therefore, if we looked at that ledger account, there'd be $10,000 on each side, balanced, we've closed it off. The next part is to do the same thing with the accumulated depreciation. Accumulated depreciation is a negative asset, so it has the same properties as a liability, so it has a debit balance. So you can see here in blue that we have debited to match that credit balance. So now the accumulated depreciation of the van ledger account will sit there with $8,000 on each side. And you can see with our yellow entry of the historical cost has debited disposal of van, while the accumulated depreciation has credited it for $8,000. Step 2 is we look at the proceeds on the disposal. So did we either get cash when we got rid of the non-current asset, someone bought it for us, or did we trade it in? So if we received cash, it needs to go in our cash receipts journal. The details will be disposal of non-current asset because it's going to go to that new ledger account, and it will appear in the sundry column, whatever amount. The other option is that we utilize a trade-in, where we're buying a new non-current asset, and then the person we're buying it from, the sundry creditor we buy it from, will give us a certain amount of money if we give them our old non-current asset. So we're talking about a delivery van here, so we give them our old delivery van that's 10 years old, and they give us $1,000 off the price of our brand new one. So this is the general journal entry for utilizing a trade-in. So we can see we're debiting our sundry creditor, JK, for $1,000. And again, we're crediting our disposal of van account for that $1,000. Because our sundry creditor will be a liability with a credit balance, so we're debiting it to reduce that down. We're not doing anything in the subsidiary ledger because this is not a trade creditor. Only trade creditors, which is buying stock on credit, will be over here. Step 3 is to work out if we've got a profit or a loss. So putting in the information so far, just posting from our journals, we need to debit the disposal of the non-current asset, in this case the van, for the historical cost here, $10,000, credit it for the accumulated depreciation of the van for $8,000 here. We're posting from our trade-in value to our sundry creditor for $1,000 here. And then just like any account, we'd balance it. So we'd have $10,000 on this side, and ignoring what's highlighted in yellow, $9,000 here. So this indicates that we're then going to have a loss on the disposal of the van for $1,000. So then we've got our $10,000 matched. So the general journal entry for that is here. It's a loss, it's going to be an expense, so it's a debit, and we credit back to disposal of the van, which you can see there. So the 4 things we need to account for is the historical costs coming from the non-current asset ledger account, the accumulated depreciation coming from the accumulated depreciation account, the proceeds, whether it be cash received from someone buying the non-current asset, or it's a trade-in to the sundry creditor and reduces the amount owed to the sundry creditor, and then whether there's a profit or a loss.